Imagine you own a coffee shop. One day, your coffee maker breaks, which brings your business to a grinding halt. You run out and buy a new one, and just like that, you are back in business. Now, while it was impossible to predict when the coffee machine would break, it was predictable that it would eventually need to be replaced. This is why the accounting concept depreciation was created. In this video, I'll explain what depreciation is, how it's different than amortization, and I'll show you how the three financial statements account for these terms by using Chipotle's financial statements as an example. Hi, my name is Brian Feraldi. I'm a financial educator with 20 years of business analysis experience. So what is depreciation? It's the accounting process of reducing the book value of a tangible fixed asset over time. So that begs the question, what exactly is a tangible fixed asset? Well, let's define each of those terms individually. An asset is something you own that's valuable and will bring an economic benefit. The word fixed in this case just means it's expected to be used for multiple years, and the word tangible simply means it physically exists. In other words, you can touch it. So at our coffee shop, some examples of fixed tangible assets are the building that the coffee shop is located in, the coffee making equipment, and the refrigerator. All of these are fixed tangible assets because we will generate an economic benefit from them, and they're expected to last multiple years. Now, fixed tangible assets all have an expected lifespan to them, after which time they will need to be replaced. If a business is using accrual accounting, then the value of these assets is gradually written down to account for wear and tear, the passage of time, and obsolescence. Now, with accrual accounting in particular, revenue is recognized as it's earned, and expenses are recorded as they are incurred. Since fixed tangible assets are used continuously over their life by the business, their value is gradually written down on their financial statements to account for their gradual wear and tear. For example, let's focus on the coffee maker for a second. Let's pretend that this coffee maker cost $10,000. How would we account for the purchase of this coffee maker on the financial statements, and how would we also write it down over time? Well, first, purchasing this fixed tangible asset would affect the company's balance sheet, which is what the company owns and what it owes. Making that $10,000 purchase in cash would immediately reduce the company's cash balance by $10,000. At the same time, its fixed tangible asset value would also go up by $10,000 to account for the fact that we now own this asset. Now let's turn our attention to the company's cash flow statement. Investing in a fixed tangible asset is also called making a capital expenditure. So we would account for this $10,000 cash outflow on the cash flow statement by recording it under capital expenditures in the cash flow from investing activity category. So we now have this coffee maker that costs $10,000, and we estimate that this will last us 10 years. So to figure out how we would depreciate this item, we simply take its cost, $10,000, divide by its estimated useful life, 10 years, and we would record a depreciation charge of this coffee maker of $1,000 per year. So this chart shows how the coffee maker's book value would decline over the next 10 years to account for that depreciation expense. Each year, we would knock off $1,000 from the value of that coffee maker to account for its gradual wear and tear. Now, we would account for that $1,000 depreciation charge on the company's income statement. We would record that figure as an operating expense, and we would use it to reduce the company's profits during that fiscal year. We would then take that $1,000 depreciation charge each year for the next 10 years on our income statement. Okay, so that explains what depreciation is, but what is amortization? Well, amortization is very similar to depreciation, but amortization is the accounting process of reducing the book value of an intangible asset over time. Now, what does that word intangible asset mean? Well, we already learned that tangible simply means it physically exists. You can touch it. Intangible simply means it does not physically exist. In other words, you can't touch it. What are some examples of intangible assets? Well, that would be things like a patent, a copyright, or a company's brand name. So just like with tangible assets, intangible assets also have a shelf life to them, and their value is written down over time to account for the intangible asset's loss of value. But instead of depreciating an intangible asset, we simply call this amortizing it. But it's the exact same concept. Okay, now that we understand what depreciation and amortization are, let's take a look at Chipotle's financial statements to see these principles in action. Here is Chipotle Mexican Grill's balance sheet as of year-end 2022 and 2023. Notice that on year-end 2023, 2022, Chipotle had $1.95 billion in leasehold improvements, property, and equipment. These are the company's fixed tangible assets. Now, over the next year, by looking at Chipotle's income statement, we can see that Chipotle wrote down the value of these assets by $319 million. In other words, the book value of Chipotle's fixed tangible assets declined by $319 million due to wear and tear. If we take a look at the company's cash flow statement for 2023, we will see that depreciation and amortization expense was also noted at $319 million. However, when looking at the cash flow statement, we will also see that Chipotle purchased $560 million in new property, plant, and equipment, aka capital expenditures. So, because Chipotle purchased $561 million in new property and equipment, but it only wrote off $319 million in depreciation, that caused Chipotle's total property, plant, and equipment value to go up by more than $200 million during this period. Now, one thing you might know about analyzing financial statements is that the terms that companies use change from business to business. Some companies use the terms fixed tangible assets, others use terms like property, plant, and equipment, capital expenditures, or more. To help make things a little bit less confusing, I created a free ebook that contains all of the synonyms that companies use when they create their financial statement. If you want a free copy of that ebook, simply visit longtermmindset.co/FSS ebook or click the link in the video description. Well, I hope this video was useful. If so, give it the thumbs up. That really helps us out on YouTube. And if you want to continue learning for free, I highly recommend you watch this video next.